Hello, everyone. Welcome to Java with Judd. This is our Friday morning edition. And if you missed it online, here's your recorded version. So, we want to talk today about part two of becoming your own bank or being your own banker. And it's very important for us to understand how all that works because we want to teach you as much about finance as we can. And the banking system, while it seems like it's very simple, is more complex than you think. And we really need to help you understand how a bank works so that you can apply those same strategies to your own personal finance. So let's get started. So here we are. You are the banker, part two, and we want to really emphasize how we can help you think like a bank so that you can apply those same principles to your own personal finance. Banking may seem simple, but there's a lot of very intricate details behind closed doors. But we're here to help you, and it's a very important part of a financial plan is learning how banks work because that is how people make money. So let's get into it. And thank you for coming to the Java with Judd this morning. And the first thing we're going to talk about is that we really have to start thinking differently. A quick story, a young couple, they bought their first house and they decide they're going to host the family for Easter dinner. So the wife says to the husband, can you take the ham out of the refrigerator and cut off both ends and put it in the pan so we can bake it? So about that time, her mother shows up, and the husband asks his wife, "Why do we cut off both ends?" And she says, "Well, I don't really know, but it's what my mom did." And her mom said, "I've never really. It's just a tradition, and my mom cut off both ends too." So about that time, the grandmother shows up, and the granddaughter asks her, "Hey, Grandma, why did you always cut off both ends of the ham?" And she looked at her rather puzzled, and she said, "Well, the main reason was because it wouldn't fit in the pan." So that tradition was carried down just because someone else before them did it. And we have to really start thinking about how things change, especially in the financial world. Because back when I graduated high school in 1981, you could get a 10-year CD that was paying 14%, which meant your money would actually double twice in that 10-year period. So if you had $10,000 at the end of that 10-year period, you were going to have $40,000 because in 5 years it was going to go to 20, and in 10 years it was going to go to 40. So it would double twice. Now, you didn't need a financial expert. You didn't need to be in the stock market. And anybody that would tell you at that point that you did, I would have to question, their sanity. So we have to think differently. We have to think outside the box. We have to realize that there are other avenues out there than just a savings account or a CD or being in the stock market, because we want to make sure your money's safe and it's there for you when you need it. We also have to start thinking bigger. We as a society kind of had things kind of rigged against us in some ways because we grind it out, we go to work, we spend that 40 hours or 50 hours or whatever overtime that we're putting into our job. We hopefully are putting money away, or your company's putting money away for a pension or a 401k, but we want to help you build wealth. We don't just want you to get to retirement and hope you have enough money. We're in the business of trying to teach you different techniques on how you can build wealth. And the bank system is one of those ideas and one of those concepts that we help people with. So if you didn't watch episode 1, you might want to go back, but I'll give you a quick recap. Banks We put money in banks, especially into savings, and they pay us about 0.5% interest. They take that money and go out and loan it to people in car loans, boat loans, home equity loans, whatever type of loan, but they're not charging like 1%. They'll get 7, 8, 9. If someone is a little bit higher risk, they may get 12 to 15% interest on the money that they're only paying us to use, maybe 0.5%. So they're using our money to make money for the bank. And yes, they have light bills and they're on the hook for those loans, but it's a lot of money they're making off of us. So we want to teach you how to make money on other people's money, just like a bank. OPM, other people's money. That's a key term. So that's a quick recap. Go back and watch episode 1 of becoming your bank and being the banker. So now we're going to teach you how to become the bank. First of all, we have to start with the bank. We have to start with an account that's going to have money in it. So we need cash. We need to have money that goes into our bank so that we can use that to make more money. In this instance, we're going to have $200,000 in our bank. And I know right away people are going to say, hey, I don't have $200,000. That's fine. We're going to help you grow to that point. It doesn't matter if you're just starting out in your financial world and you're a young professional, or if you're approaching retirement or anywhere in between, or even in retirement. We have a lot of people that get into retirement and they don't have they don't have a plan, and that's where this concept will come in handy too. And so it's for all ages. Don't get scared because I put $200,000 up there. We can get people started for 39 cents an hour from zero. So just remember that. Sorry, I haven't had my Java this morning. On this bank account, we're going to pay 7% interest. This is a special type of account. When you get this started, whether you're starting with $1 and building it from there, or if you have the money to put in 50, 60, 100,000 per year, or however we can design that, we have a death benefit that starts from day one. That's payable to a beneficiary, no questions asked, no taxes. So this is a special type of bank account, even better than the one that you go down to the corner to put your money in, or direct deposit, or however you do it. So we have that added death benefit right away. So remember in the part 1, the banks have to receive money, and they make money by creating loans to people for cars or whatever. So we're going to do the same thing with our bank. We're going to loan money out, and of course, with the loan, there has to be a charge, but we're going to only charge 1% on our loan. Now you're probably already thinking, Judd, how can I make any money for my bank if I'm only going to charge 1%? You just said banks charge 7, 8, 9, 15%. That's right, they do. But hold on, and I'll show you why this is going to work great. So in our bank, we're going to start taking out $20,000 per year, non-taxable. This money is going to come out of our bank, and it is not taxable. And you're like, well, why am I taking money? Why am I not loaning the money to somebody else? You're taking the loans for yourself. You are the customer. You also own the bank. So you can, or you don't have to pay it back. You decide. And I think when you see this next part, you'll understand what I'm talking about. So in our special bank, we are still going to earn 6% interest on the money, the distributions that we've taken out of our bank. So every year we take out $20,000. At the end of 5 years, we've got $100,000 that we've taken out of our bank. but we're still earning 6% interest on that money that you've used to buy groceries or pay car payments or whatever. And when you get to 10 years, you've taken out $200,000. Now, you're still earning 7% on the money that's inside the bank, but the money that you've taken out of the bank is earning 6%, because remember, we have the 1% loan feature on this bank. So we're charging 1% as we take the money out, but this bank is going to credit you back, even though that money is in your pocket or you've taken it home and use it to pay bills. We're still going to pay you 6% interest on the money that left the bank. Okay, I don't know how it gets any better than that. You're your own banker. You get to control all the rules, and these are the rules that this bank will allow us to do. So there becomes a point there in this process. If we keep taking out, it has to be structured correctly, but if we take out enough money, there will be a point where you're actually putting more money back in the bank when you take a loan than what's coming out. So there'll be a point where you're actually taking $20,000 out, but the interest that is generated by your bank will actually be 20, 21, 22,000. So your account will actually start to grow. I know it sounds crazy, but this is a legitimate bank, and we'll talk more about that in the next slide. So this program is what we call our life pension, because it has the cash, it pays about 7% interest. It does have a $350,000 life benefit, or whatever you have set up. You may start out very young in your career, and you may not have that much death benefit in the beginning, or you may have much more than that. But we can specifically design this life pension for your roof. Recently, I don't know, I haven't seen anybody that it was less than 15,000. So if you have to take out $15,000 out of a 401k or out of an investment, you're going to pay the tax. So, Mr. Client, do you have the money to pay the tax? I'd rather not deplete my savings. Okay, so we can take money out to pay the tax, but now we've extended that to maybe 20,000. That's going to cost to actually pay for the roof, because we had 15 to pay for the roof, took out another 5,000-6,000, so we're at 21,000 for that roof. If we had something like this, the life pension, we can take money out without paying the tax. So we can continue to take that $20,000 out a year, or we can let it grow, and in 2 or 3 years we could take out 60,000. Let's say you want to buy a new car and you don't want to finance it or anything like that. Well, you could take out 20,000, wait another year, take out 40, go to the bank, take your loan out. You know that you don't have to pay it back. Go write a check for that car, okay? Because it's your money and you can do whatever you want with it. If you're comfortable with your pension and your 401k and your Social Security, and you don't need this extra money, let it grow. Let it get past the next generation. That death benefit will continue to grow as you move through. Okay. So what do we have to do? Well, of course, in any bank, we have to deposit money into the bank. In return for depositing money, your bank will pay you a usage fee or interest rate back at 7%. As you take loans, your bank will charge you 1%, but will credit you back 6%. I don't know where you get that kind of money. Go to your bank, take some money out of your savings and say, could you please pay me interest on this money that I just took out? And they may have you committed to an insane asylum. I don't know, but it's not an option that most banks have. So in this example, like I just said, you could take out annual loans of $20,000. Your bank, after 10 years, you would have taken out 200,000. That's earning 6%. That interest is credited back to your bank. How can it get any better? Plus, you still have a death benefit. Wow. Okay, you are your bank. You're taking loans and the interest is being paid back to your bank. So there'll be a point in this process, like I said, where your account value in your bank will actually start going up, even though you're still taking loans. Wow. Okay. What kind of product, Judd? That's not a typical bank. No, it's not. But it's a properly designed, max funded. Now, there's a lot of people out there that can write what we call life pension, but it's actually an indexed universal life. Look it up, Google it, index universal life, but it has to be properly designed for what you want it to do. If you're wanting to take distributions down the road, we have to help you design it. 99% of the advisors out there don't understand it and can't properly fund it, and it has to be maximum funded. So the government only lets us put in X amount of dollars per thousand of life insurance. So we've got to make sure we max fund that. And then there's some other things that have to be done along the way. And we know what those things are. So in order for us to help you with that life pension, we've got to set it up properly. The life pension is actually the same thing we talked about with the bank. We're going to get around 7% interest. There's a 1% loan fee, and you're going to be earning. Judd, love it. Love everything you said. I don't have that kind of money. That's okay. We can help you get started. It doesn't matter how much you have right now. If you're a young professional, we can start you out at about 39 cents per hour, $15 a week, $20 a week. In order for this to really buzz, we'd love to see you put in $100 a month. If you can't do that right now, we can increase it gradually so that we can get you to the point where this will really make a difference. And this is the starting point. We have other ideas to help you create wealth while you're working toward retirement. How do I get started? How do I find out more about this? This sounds really crazy. I want to talk to you. I want your advice. I want you to look at what I have and maybe we can fit this in. Perfect. Email me at Judson_Tolmen@Hotmail. Please check us out on YouTube. We're getting a lot of videos out there, and please subscribe. That way you'll get the most recent videos that we've put out there. Also, register with us. We have bonus newsletters and bonus videos that don't go out on YouTube. So go to tolmanfinancial.com/million. That will get you to a sign up page. We are not going to sell your stuff. We're not that company that as soon as you click that button, you're going to get 14,000 calls from people all over the world trying to sell you health insurance or auto insurance or whatever. We don't do that. We're simply going to put you on our list, and you're going to get our emails as we send them out. If you have questions, please contact us. That's how we do business, because we know we have value in what we are recommending to people. And by the way, we don't charge. I know we've had quite a few customers come to us from the Edward Jones type company, and they want $10,000 just to look at their stuff. We don't do that. Bring all your information. We'll look at it. We'll give you our recommendations. You may say, hey, Judd, that's crazy, but I do like this part. Fine. We'll help you implement that, but we'll also keep up with you. So many advisors, they get you under their wing and then you never hear from them again, or you have to go knocking on their door. We're going to constantly make sure you're updated. This financial literacy is an ongoing process. You have to stay up on things because look, remember I said 1981, the interest rates were 14%. We don't have that today. So we have to pivot and find out what works for you, but we want to make sure your money's safe. And there's nothing wrong with being in the stock market, but the majority of your money should never be there. watch some of our other videos on the 401k, and you decide where you should have the most of your money to help you make sure that you're living a great retirement. So for me, that's it for this edition. There's a lot more to this banking process, but we'd love to talk to you about it. Find us on YouTube, like I said, but most importantly, enjoy your day and enjoy your weekend. Thank you for stopping in.